GrainCorp was originally founded by the New South Wales state government in 1917. Later, it was then bought by a group of farmers in 1992. Since then, GrainCorp has grown from state-based company to an international agribusiness that has a diverse income. GrainCorp partners with local growers and farmers to connect with them international and domestic for their products. GrainCorp also manages a wide range of grains, pulses, and oilseeds, and produces edible oils, biofuel components, and animal feeds, as well as oils and shortenings for the food production industry. GrainCorp became a publicly listed company in March of 1998 when a share was worth $2.91. The Australian Agricultural Company produces and sells beef. The company operates properties, cattle stations, feedlots, farms, and beef processing facilities throughout Queensland and the Northern Territory. The farm runs roughly 455,000 head of cattle that run in 17 million acres, which put in perspective is 1% of Australia's land mass. The Australian Agricultural Company became a publicly listed company on the 10th of August 2001, when on its first day of trading the stock price was 97 cents. GrainCorp has many agricultural services, from things such as marketing, selling, and the storage of grains such as wheat, barley, canola, oats, and sorghum. GrainCorp also assists in the transportation of their grain through trains and prime movers. The Australian Agricultural Company operates a strategic balance of land, feedlots, and farms, taking up 6.5 million hectares. The Australian Agricultural Company mainly focuses on and specialises in their grain-fed Wagyu beef production. Alright, moving on to some vertical and horizontal analysis on GrainCorp. Starting off with horizontal. Now, in revenue, looking under the 2023 versus 2022, we can see a 4% increase in revenue. And looking back towards 2022 and 2021, there was a 30% increase. Now, this is a good sign as it is showing us that revenue is actually going up in the company, which can mean good things if we invest. Now, moving on, other income and loss, that was down from 2023 to 2022. It was down by 355%. And this is good as it's showing that they're cutting down on their losses and other sorts of income, which is good as they allow to spend their money elsewhere in order to help the company flourish. Now, moving down, profit. Looking in the vertical side, the company is still making profit, although hasn't made as much profit as it had the last year, although it is still higher than 2021, which is there. Now we can see, looking vertically, it did lose 52% in profit from last year, which isn't as good, although it could be meaning that they are spending money elsewhere in order to help the business do better and investing all their profits back into the business, which can be seen as a great sign. Now, moving on to the Australian Agricultural Company's vertical and horizontal analysis. Starting off with our first value, which is total revenue. We can see across the 3 financial years here that revenue is actually driving up, which is a great sign. And if we move that over to horizontally to a percentage, we see that from 2023 to 2022, revenue is actually up 11.9%, which is actually really good. And moving that back a year against 2022 and 2021, it is up 3%. Now that shows us that revenue is ultimately on a very steady increase, which is very good for the company. Moving down to operating costs. Now, as we can see vertically here over the 3 financial years, it is steadily increasing. Now, that is obviously going to happen when you do buy more land. Obviously, operating costs is going to go up. It's just a common thing. Now,
If we move across to our percentages last year, which is 2023 compared to 2022, it is actually up 21%, which is quite a lot. But it is taking away from profit and things like that. On that agenda, cattle and feedlot expense, looking at this vertically, same thing is happening. It is also driving up. Now, looking at that in comparison from 2023 to 2022, it is up 6%, which isn't as bad as the other expenses. Um, Moving down to profit after tax, vertically, we've seen a massive drop from 2023 and 2022. Now, how much that drop is, moving over to horizontally, that figure is 2,869% down, which obviously is not great and it is not a good sign if we're going to invest. Now, that it also could be because they've just purchased quite a substantial amount of land, which could be where their profits are going, which could also hint to why the expenses are quite high, and things like that. So there could be a little bit to back up there, but at this stage, things probably aren't looking as good as GrainCorp.
Moving on to some key stock metrics. Now, the main ones that I'm going to talk about are quite well known, them being earnings per share, price to earnings ratio, and dividend yield. Earnings per share indicates how much money a company makes for each share of its stock. On the 5th of November 2024, GrainCorp has an earning per share of 439 cents, whilst the Australian Agricultural Company has an earning per share of negative 157 cents. Putting the two companies in comparison, Australian Agricultural Company currently have a negative earnings per share rate. This could indicate one of the two things. They might be currently spending more than they are earning, or their profits are slowly decreasing. Comparing this to GrainCorp, it has a much higher earnings per share rate, meaning that it is going to turn over much more profit than the Australian Agricultural Company will. The price to earnings ratio is a proportion of a company's share price to its earnings per share. On the 5th of November 2024, GrainCorp had a price to earnings ratio of 20.41%, whilst the Australian Agricultural Company had a price to earnings ratio of negative 11.32%. In comparison, GrainCorp has a good benchmark at around the 20% mark. This tells me that the price of the stock isn't overpriced and it is sitting at a relatively good number. However, the Australian Agricultural Company's ratio can say a lot about its position in the market. With a price to earning ratio at negative 11.32%, it tells me that the company is currently losing money, although this doesn't tell the full story. Taking benefit of the doubt, the reasoning behind the negative price to earnings ratio might be because of environmental factors such as drought. Looking at the two in comparison, GrainCorp has a much more attractive price to earnings ratio and is much more safer and appealing as an investor. Dividend yield shows the annual dividend paid out to shareholders as a percentage of the stock's current price. On the 5th of November 2024, GrainCorp had a dividend yield of 5.94%, whilst the Australian Agricultural Company had a dividend yield of 0.00%. Firstly, taking a look at GrainCorp's yield value, with the value being a very high end of 5%, makes for a very safe and secure value. Looking at the Australian Agricultural Company's yield value of 0 can indicate a warning sign that the company is currently struggling and is experiencing financial hardships. This could mean that investing in the company could be a big risky move. Looking back at the past 6 months of both companies in the stock market, I thought I'd do some investigating and I took it upon myself. And if I had bought $500,000 worth of shares 6 months ago, which being the 1st of May, and sold them exactly 6 months later, being the 1st of November, how would they have went and what would they have earned me? Now looking at GrainCorp, a share back in May would have cost me $8.27 per share, and $500,000 would have got me 60,459.5 GrainCorp shares. 6 months later, the share price was worth $8.92, which if I had sold all the shares I had bought, it would have earned me $539,298.07, which works out to be $39,298.07 in profit. Moving on to the Australian Agricultural Company, in May, an AACO share was worth $1.346 per share, and $500,000 would have bought me 371,471 shares. In November, the share price had reached $1.380, which if I had sold all the shares that I'd bought, I would have made $512,630, which would have been $12,630 in profit. It is very clear that GrainCorp had made me more money in the 6-month period, and would it be seen as the pick out of the two.
Now, there was an article posted on the 10th of October 2024, which was about GrainCorp, where workers were threatening a strike over the upcoming grain harvest, which is about to commence, which it is currently now in the midst of. The strike is said to be because of the lack in pay. Workers say that their pay is only going backwards. Workers say that their pay rises 2% per year, whilst inflation is on a much higher rise. Currently, Harvest 2024 is in full swing, with many farmers across Australia stripping their crops as quick as they can. Last year, GrainCorp had a receivable of 426,200 tonnes of grain throughout the 2023 harvest season. GrainCorp are expecting the same amount, if not more, grain this year. Without all staff on board, the receivable of this amount of grain will not be possible. The effect of this will create GrainCorp to lose lots of money, as this is their busiest time of the year and initially is going to drive their stock prices down, which will not be good if we invest. An article about the Australian Agricultural Company mentions that the farm has increased its herd size by 5%. Although we're doing so, the overall herd worth has dropped by 150 million. Australian Agricultural Company says that the price will slowly start to make its way back up, but it would take time. It also touches on what they are going to work on for the farm's 200th operating birthday. They have launched their 1824 Wagyu brand and are working on Wagyu beef bacon. They say that they are aiming to target the gap in the market for those who want bacon but can't or won't eat pork. They end the article by saying that they have received a lot of positive feedback on their product. With all this being said, there is a lot to take away from this. Taking into consideration the financial position of both companies, making an investment into GrainCorp is going to be the safest option, but still providing plenty of gain. With the fairly pricing of shares and good return on investment, investing in GrainCorp will make a great long-term investment, whilst having lots of ease knowing it is a safe and secure option rather than the Australian Agricultural Company. Thank you.